my name is Ed Gilmer. I'm the Director of Capital Markets with PassiveInvesting.com. You can read more about me in our bio on our website. While you're there, be sure to look at our current offerings for investments and see what deals we have coming up. If you'd like to learn more about the PassiveInvesting.com club, check out our website too. Today, our topic is on multifamily debt in today's market. But before I get started, I want to see where everybody's joining us from today. I live in South Carolina, but I'm visiting some family in Florida. So let's see where, go over to the chat. Al's in Hawaii, a nice spot. Tahoe, West Coast, upstate New York, here we go. California, all over. Atlanta, NC, Estonia, Texas, Canada. We have some international viewers. Chicago, Houston, I like it. All right, and Tampa, the same state I'm in right now. I'm in St. Augustine. So, interest rates on multifamily deals is a fun topic of conversation recently. They're pretty high. That's what it is. I think there's some good news coming the next 6 to 12 months for rates, but right now, what I was trying to think about in this market is what's working for people looking to buy properties, refi, etc. Feel free to drop some questions in the chat, and we can go through those throughout the talk today. We've been looking at a lot of deals, multifamily deals recently, and a lot of them don't underwrite just based on debt, your insurance cost, many factors there. But what we are seeing is working. We've gotten very close on a couple deals recently, and the ones that are working are, if it's a newer deal, it's stabilized or near stabilized. As far as the agency rates go, that's 85% occupancy or better. So once you're there, they consider it a stabilized deal. You get some more favorable pricing. Any deal not quite at 85% occupancy, you're likely looking at like a bridge solution. We looked at a deal recently along the East Coast. It's been around for a few years, 93% occupancy. We were looking at an agency rate. You're still with agencies in the 55 to 65% range loan to value. Historically, it's been a little higher. I think when rates come down, that will go up a bit. But we're looking at that deal. Agencies are usually based on treasuries, your 5, 7, or 10-year treasury rate plus a spread of 180 to 210 basis points, depending on the setup of that. But treasuries have spiked recently as well. So it's this odd combination. The 10-year treasury is right at what, 390 today? Plus, basically 200 points from the agency spread. So that puts you at about a 590, almost 6% rate fixed for 10 years. Still pretty high historically. I think a lot of our strategy on deals is to look at some rate buy down options. You pay a few more percent upfront or a small fee upfront to reduce your rate over the 10 years. The payback period on that is usually a 3 to 4 year hold period. So once you cross that, it's simple math to see what does and doesn't work. On the bridge deals or any property we're looking at that's not quite stabilized at the 80-85% LTV range. Yeah, bridge. I've seen bridge LTVs get up to 70 recently, maybe 72, 73 for the right deal, which is nice to see those kind of coming back. For a while, bridge debt dropped to 60%. Those deals are still going to be SOFR based, SOFR plus a spread. I've seen SOFR plus 300 recently, 325. A year ago, that was maybe 350, 375. So it's nice to see the spread come in a little bit there. But with those, any deal that I look at, I'm buying a rate cap to cap SOFR significantly below market rates. I believe I've discussed this on a few previous webinars. If you're not familiar with rate caps or SOFR, drop something in the chat and we can go into that. But one deal we recently looked at, we were looking at pricing out SOFR cap of 2%. For those of you who don't know, SOFR right now is 5.25 or so. So you're in the money day one. You're going to be getting a rate cap payout day one as part of your cash flows. So if your deal is SOFR plus 300 and you're capping SOFR at 2, it's 2 plus 3, you're 5% fixed for the 2 or 3 year bridge term you have, which is not a bad deal. And a lot of debt funds will actually fund the rate cap purchase to offset your capital. So, all right. So Roy, can you explain SOFR? So SOFR is an index. It came about in about 2020 when LIBOR was initially phasing out. It fluctuates. This a year and a half ago, SOFR was 0.05% for years. It's kind of an afterthought. At the time, everybody was buying rate caps of SOFR 2%. So when SOFR is 0.05, you're buying a 2% cap. You have a lot of room to run there. Unfortunately, in the last 18 months, SOFR rate has gone from basically 0 to 5.25, which caused a lot of multifamily property holders some stress if they don't have that rate cap. I see Mike asks a little more detail on rate caps. So rate cap is just fixing a floating rate. So SOFR fluctuates. You're saying, hey, I'll pay this company, a third party, X dollars for them to cap our SOFR at 2%, 3%, 4%, whatever it is. The lower the rate cap, the more costly it is. For example, if you're buying a deal for $50 million, you're doing a $30 million loan, 60% loan to value, right? So you would look for a $30 million SOFR cap at 2%, for example. They'd say it cost $850,000 for 2 years. SOFR caps are based on dollar amount, the SOFR cap number, and time, 2 years, 3 years. It's basically a bet that you think SOFR is going to stay above that for longer, and they pay you the difference. So right now, like I said, SOFR is about 5.25. So if you buy a 2% rate cap, you're getting the 3.25 spread paid back to you monthly. So that $850,000 rate cap you buy at closing would pay back monthly to some extent. If rates over the long term are higher than expected, you make money. If they drop faster, then you would lose money based on your initial investment. Most lenders that do floating rates would require a rate cap, so you don't get into trouble. You've probably read some headlines or some articles about other multifamily property holders getting in trouble when they have these SOFR plus 300, SOFR plus 350 loans. Those loans are now 8.5%. Nobody underwrote that 2 years ago. So what the SOFR cap would do is limit your exposure to, again, SOFR 2% plus a 350 rate cap. SOFR 2% plus a 300 spread, you're 5% fixed. So even if SOFR went to 5.25 plus your spread is 8.5, you're only paying 5% interest and getting the difference paid to you by the rate cap provider. So Mike, I hope that answers your question. We can go more into rate caps on another webinar if you want to. One of the things everybody asks about is the Fed funds rate forecast. Where do you see it going? Depends on who you talk to, what day it is. Obviously, the Fed meets today. They're going to announce a 0.25% rate hike. Hopefully no more after that. But one thing I've found is I like to listen to people smarter than me. Let me share this image here. This is from a group called, can we see this? I'm sharing this image here. This is from a group called CME Watch Group. They poll all these people and what the percentages of increases of Fed funds rate over the next meeting dates. Here's your meeting dates, right? So today, tomorrow, basically 100% chance they're going to hike a 1/4 percent point. Right now, we're 500 to 525. There's a pretty good chance in the September meeting they're going to hike again. Excuse me, keep it the same. So keep it the same for the next perhaps 6-7 months. The further out this forecast gets, the more spread out your opinions get. So right now, you can see the date tomorrow is pretty much 100% of hiking a 1/4 point. Even 2 months from now, it's 80%, 20%. Then it goes to 60, 35, 5. So it kind of gets spread out. Once you get past the middle of next year, it's anybody's bet. I hope this is right. I hope we end up at 400, 425. That'd basically be cutting the rates 1 to 1.25% in the next 18 months. I think it would be a good thing. So let me get out of that. That's called CME Watch Group. You can Google it. Mike's question: how accurate has this data been historically? The closer to the date of the meeting, the more accurate it gets. Sometimes you could be 2 weeks out and they'll release another report, like a CPI report or a PPI report, and it'll change overnight. It'll change that day. Obviously, tomorrow is pretty solid. We're going to get a 1/4 percent hike. Hopefully, nothing past that. A lot of people thought earlier this year we were done hiking rates after, what was it, March or April or so. Some reports came out hotter than expected, so they're going to keep hiking for whatever sense that makes. I don't agree with it, but nobody asked me. So I do think rates are going to stabilize the next 6 months. Back to the rate cap question, the price of rate caps is heavily dependent on the forecast of rates going forward or the unknowns. It's kind of like an option. The good thing about tomorrow, if rates are hiked another 1/4 point and nobody expects them to be hiked anymore, the price of that rate cap will come down. On all the bridge deals that were done in 2020 and 2021 that are starting to come up for your rate cap expiration, you're going to have to buy another rate cap if you don't refi it. And the cost of that rate cap after tomorrow in the next couple of months should come down significantly because there's more certainty. So the next 6 meetings are predicted to be even. There's more certainty in the market of where rates are going, whereas 3 or 6 months ago, there's a lot of uncertainty. Uncertainty means whoever's selling the rate cap is pricing in the risk and costing you a lot more money. We monitor our rate cap renewal prices consistently. I look at them weekly, if not daily. I think with this, the cost of some of those renewals coming up will drop significantly. And once we're 12 to 24 months from now, rates in general will drop. That'll be good for everybody. I think more properties will be ready for refis. The curveball here is if we do go into a recession, then all things are off the table. Everything's different there. But another option we've seen working recently, we've looked at a few more deals that have a loan assumption. Loan assumption being if somebody bought the property a few years ago, they did an agency rate, a fixed rate deal or floating or whatever. Most agency deals are 10 years historically. Now you can get a 7 or 5 year and possibly some other options there. But traditionally 10-year agencies have been kind of the gold standard. We were looking at a deal, I think they bought it 4 years ago. There was 6 years left. No interest only. So it is amortizing, but their fixed rate was like 4% or 3.9%, which you can't get in today's market. So because of that, that adds a little bit of premium to the price of the property when we're buying it. That was one of the first ones we saw that was in the amortizing period that we liked. A lot of the agency deals are interest only for a portion of time and then amortizing. If you can get a deal that's still in the IO period, interest only period, it's more favorable, helps cash flows, pretty straightforward there. Loan assumptions. So we like loan assumptions. Sometimes sellers price that premium. If a property is, let's say, a $40 million property, but there's a loan assumption on it that's going to lock your rate in at 4.5%, 4% for the next 6 years. That might bump that price up another couple $1 million to do the loan assumption. Another option is to buy it and not do the loan assumption, but that means the seller's going to have a prepayment penalty to pay off the loan early. On most agency deals, you're going to have a 10-year deal. You're going to have a 9.5 year prepayment penalty. So if you sell that deal or pay the loan off prior to that, there's penalties. And any seller getting out of one of those is going to want to be compensated from the buyer. So when you're offering on a multifamily deal with a debt assumption, a loan assumption, and if you're assuming the debt, your price could be here. If you're not assuming the debt, you're going to have to offset that loss to the seller to cover the prepayment penalties. We ran into one of those recently where the loan assumption didn't work for us, so we were going to do our own debt, a different debt option, but we would have had to have been a higher priced offer to the seller. I think they had a $900,000 prepayment penalty. We got close on that one. It didn't quite pencil out for us. So on that note, we're being very, very careful in this market as to what deals we do buy and don't buy, given where rates are going. I think a lot of seller expectations are still pretty high, and there's some room for seller prices to come down, take a little breather considering where rates are with the demand and all that. Let's see. Mike has a question here. I'm gonna get a sip of water 1 second. Mike says, besides price being increased, what would be a reason for not assuming a loan given that it was a favorable rate? So if you could do an interest-only option, not assuming the debt, let's say a debt fund or a life co interest-only option, or an agency deal where it's amortizing at a lower rate, even though the agency deal has a lower rate, if your interest-only option has better cash flows, that's something I would do, especially if you buy a SOFR cap below the market. My example earlier, if you bought a SOFR 2% cap plus a 3% spread, it's a 5% rate. So 5% debt interest only is likely going to have lower payments than a 4% deal amortizing. Hope that works for you. But that being said, we need to look at every financing option on every deal every time. So on that deal, it might not make sense, but if they had a 3% agency fixed rate, maybe an amortizing 3% deal makes more sense than a 5% interest only deal. So I would encourage everyone here to look at every financing option on every deal. If you could go to the chat, let me know who's buying properties right now and what kind of debt solutions you're finding that are working. We've seen a lot of cash buyers recently on deals we're running up against or offers. We're getting offered together. All of ours include debt. We ran into a couple cash buyers. One was in Texas. It's a $55 million deal. It was a few months back. We were put a strong offer. I thought we were going to be one of the top contenders, and a cash buyer, an institutional buyer, obviously came in, paid cash. Not only bought that property, they bought all the seller's properties. It was a national developer. They bought 8 or 10 properties from the seller in one transaction. So that makes it hard to compete, given all losses equal. Another option I've seen is some of these cash buyers, if they have a lot of cash on the balance sheets, would come in, buy a property all cash, and then wait a year, 2, 3 years later and refinance once interest rates are lower. So if they can carry that amount of cash expense for a while, maybe it makes more sense to refi later. Tom says, seller financing is available. I'm a huge fan of seller financing, always better, usually better terms. So if that is an option, maybe the seller owns a property in cash, or if they have a very low basis, you would just pay off their loan and finance the rest by the seller. But seller financing is always number one option if it's an option. A lot of these bigger multifamily deals, it just doesn't work. You know, they're carrying a pretty significant note for them to pay off, but always ask if seller financing is available, because with market rates being, you know, 7, 8, 8.5%, maybe you get seller financing at 4 or 5%. You're going to have much lower closing costs, probably no origination fee. You can get interest only for as long as you want, likely, if you negotiate up with sellers. So most sellers are not as sophisticated as agencies or debt funds when negotiating deals. So great call there, Tom. Any questions on what other debt types are working in today's market? Like I said, we've been running up against a lot of deals recently where we're getting really close. We think we're going to be in the top couple of offers, and just not quite getting there yet. We've been very, very close on a couple, but let's see. Scroll up. Yeah. Tom mentioned is looking at some preferred equity, basically. We've had people reach out to us and offer preferred equity of 9, 10, 12%. It just doesn't seem to make sense on a lot of deals. If you have to have preferred equity at, you know, 10 or 12% to be able to reach your refi targets, with 6% debt, it's a strategy to look at. Again, I always encourage people to look at all the strategies, but I think for that one, for our purposes, has been tough. Given the expectations of some of this pref equity, second position debt, whatever it may be, usually pretty high. If you find somebody wanting to do 4 or 5% debt, let me know. So let me go to the Q&A section here. Let's see. Rob says, when do you think rates are coming down? Kind of got into that earlier. Are cap rates expanding from multifamily in the areas you're dealing in? So I can answer that partly. That's partly a question for our acquisition team, but generally speaking, yes. We are mostly in the Class A Sun Belt, I would say North Carolina, down to Florida, over to Texas kind of market. North Carolina, Tennessee, Florida, Georgia, and Texas, basically. And a lot of those markets, you're starting to see cap rates on Class A properties, upper 4s, maybe 5. We've seen a couple a little bit over 5. Anything much more than that, you're going to be getting into like Class B, maybe A-, Class B. Anything over 6 is probably Class B- or C. So there is some. I mean, we're not at the 4% cap rates we were a year and a half ago. I think I mentioned this last time. The relationship between cap rates and interest rates. Right now, if interest rates are 7.5%, 8%, 8.5%, and your cap rates are 5%, that's gonna be tough math on a deal. The closer cap rates and interest rates are, the more likely it is a deal would likely work from a very high level. Let's see, Justin has a question. Any interaction with motivated sellers, motivated due to loan maturity, need loan covenants? I read an article. Sure, I've seen. I think we're just going to start getting into that. So we're in July 23. Most of the multifamily activity came Q4 21 and Q1 and 2 22. I back that up a little bit. So the second half of 21 and the first part of 22 was pretty heavy in the amount of acquisitions. I was at a conference a few months ago. And they said like Q4 21 had like $160 billion of transactions. Q1 of 23 was like 20 billion of transactions. It's a fraction. But the point is, if all those people in Q3 or 4 21 did a 2-year bridge deal, they're coming up on their first year extension right now. Most bridge deals, the first extension would be just buy another rate cap, but that rate cap might be too pricey for them. That could be a motivated seller. Any deal bought in 2020, so you bought it in Q3 or Q4 of 2020 with a bridge deal, and you did a 3-year bridge deal, 3-1-1. So your 3 years would be up. Second half of 23, you'd be running into debt yield and DSC hurdles, and I guarantee you they're not hitting those for the most part. You're going to be short on debt yield. You're going to be short on your DSC test. A lot of those properties would have a 125 DSC test. Debt yields anywhere from 6 to 9%. Debt yields NOI divided by mortgage balance. So I think there's going to start being more properties that are out there for sale. Most groups will likely get creative and try to not sell them. I don't think it's the best market to sell a property in. Generally speaking, I think the right property, the right market might work. He says something to the effect of 30% of loans maturing would require a capital call to meet DSA requirements. Yeah, a very, very good point there. Capital call or reserves. A lot of 2-year bridge deals, you would just buy a 1-year rate cap, so that's just cash. So I wouldn't necessarily say a capital call, but would require capital to buy down the loan, to pay down the loan to meet DSCR requirements. So depending on how well-heeled or well-reserved a multifamily operator would be something to ask there. Anytime you're investing in a deal, you want to make sure there's enough reserves to carry them through these times. So great questions. Back to the Q&A here. Eve had a question called, what is it called? I don't know what you're referencing there. If you still have that question, just elaborate more, please. All right, well, if we have any more questions, go ahead and drop them in there. Anything multifamily debt related, anything multifamily related, happy to answer. I'd love to hear what's working for some people, what's not working. Again, it's a tough market, but I think the next 6 months will, with the certainty in rates going forward, I think it's going to make things a little bit better. And if we can avoid a recession or have a soft landing, as people say, I think 24, 25 is going to be great years. There's going to be a lot more product coming to the market. There's been a lot of developers that broke ground 2 or 3 years ago when things were really hot. And those properties are coming to market now. Probably not going to sell for what they thought they were. That's back to the question of motivated sellers, Justin's question there. I think some new properties in 2020 or 2021, when they broke ground on construction, they thought things were going to keep going this way. They're going to be taking some hits. There's going to be some developers probably looking to get out of properties for even, maybe make a few bucks compared to historically, significant profit there. So new properties might be something to look at. The earlier you can get one under contract, probably the better deal you're going to get. If you can get debt on something with 10, 20, 30% occupancy, you're going to get a better price than if that property has already hit 70, 80% occupancy. So there's more value with a higher occupied property or so. Well, if there's not any more questions, I would like to thank everyone for joining us today and look forward to talking with you on the next webinar. Thank you.